So now you see how home buying demand is set to fall off a cliff at some point over the next year. And when home buying demand falls off a cliff, you know what that means for home prices. They're going to go down. And this is something that every home buyer and real estate investor needs to understand. All right, everyone, how's it going? This is Nick. I am back here with another Reventure YouTube cast, and this is a video that you guys, if you're a real estate investor, if you're a home buyer looking to get into the market in 2021, this is a video that you must watch. We're going to talk about how the U.S. housing market is in a bubble right now. It's in a massive bubble that is set to crash at some point over the next year, probably in late 2021 or early 2022. And in today's video, we're going to talk about how a decline in home buying demand, an inevitable decline in home buying demand, is going to cause that crash. So this video is actually the second in a three-part series on the U.S. housing bubble and subsequent crash. The first video, which I posted last week, talked about how housing supply and inventory is going to increase over the next year. This video is going to talk about the other side of the equation, how home buying demand is going to decline. And as you can see, that's a nasty combination for the housing market. If supply is going to go up and demand is going to go down, well, we all know what's going to happen to home prices if that occurs. So if you're a home buyer, a prospective home buyer, or you're a real estate investor looking to buy a townhome for a rental or a multifamily for a rental, this video is really important for you to watch because it's going to provide the data that you need to correctly time your decision. I produce tons of this data-driven real estate content. If you're new to this channel, make sure to subscribe. I post 2 videos every week on real estate markets and data across the US. And I actually have the third part in this 3-part series coming out next week on how prop tech is inflating the bubble and is going to cause the bubble to burst. So you're not going to want to miss that either. So make sure to subscribe. And then please also make sure to hit the like button. I put lots of time into these videos. I love sharing this content with you guys. It would mean a lot to me if you could just hit the like button. That tells YouTube it's a good video and that it shows it to more people. So without further ado, let's get into why home buying demand is set to decline over the next year and how that's going to cause a crash in the housing market. So to start our discussion on home buying demand and how it applies to the housing bubble and the subsequent housing crash, we need to look at the basics. And the most basic statistic you can get in terms of home ownership demand in the United States is the home ownership rate. That is the percentage of households in the country that own their home versus rent their home, or I should say rent their apartment. And so the home ownership rate right now is 65.8%. That means that 65.8% of households, of the roughly 125 million households there are, 65.8%, or 83 million, own the place that they live. And this is a really important metric because to sustain home price appreciation, you need that home ownership rate to continue increasing. You need renters to convert to owners. If renters continue converting to owners, that's going to cause home price appreciation. However, the problem that we're running into now is that 65.8% is very high historically. That is a very high home ownership rate historically, and that means that we're probably going to see less and less home buying demand into the future. You can see what I'm talking about on this graph, which looks at the annual home ownership rate in the United States over the last 55 years. So we have lots of historical context here. And I think the one thing that jumps out to me, and it probably should jump out to you, is how consistent this metric has been over time. Basically in a range of 63.5% to 65.5%. That's where the U.S. home ownership rate has ranged over the last 50 years. Now, in the early to mid 2000s, we see a change. All of a sudden, the home ownership rate spikes up to 69, 68%, and that caused and fueled the massive housing bubble that this country experienced in that time frame. And it caused the massive crash that we saw from 07 to 2012, where home prices went down by 30, 40, 50, 60% in certain markets. But this was really an outlier fueled by rampant speculation and basically no lending standards whatsoever. Anyone who applied for a loan got a loan. Home ownership rate then went down all the way back to 63.8% in 2016. And now it has jumped back up to 65.8% in the fourth quarter of 2020. If we want to continue seeing the record home price appreciation we've been seeing and want to sustain the record values we've been seeing, this 65.8% is going to continue, it's going to need to grow. It's going to need to go to 66.5%. It's going to need to go to 67%. It's going to need to continue increasing, but that means renters becoming buyers. And if renters become buyers, that fuels demand. But we can see that 65.8% is historically high, right? This yellow line, that's kind of the average, the long-term average is 64.7. We're at 65.8. So we're already above the long-term average in home ownership in America, and that likely means that we're going to see a slowing and decline in the demand for housing. So the historical trends are saying that the run-up in home buying demand that we've seen not only over the last year, but even in the 2 years prior, in 2018 and 2019, we saw a run-up in home buying demand, that's kind of running out of steam, right? We had a lot of renters convert to owners over the last 3 years, but there's just not going to be a lot more of those coming to sustain the demand. And that's going to be a principal cause of why home buying demand declines over the next year and why prices will probably decline over the next year. However, there's even more to it than that. And so you guys have probably heard about the K-shaped recovery that we've been experiencing, or the K-shaped recession. And what that means is that, the COVID crisis has caused a big recession across America and the world, but the effects are very unevenly distributed, right? If you have a high education, a good job, you aren't feeling the effects too much. But if you have a lower education level or work in the service industry, or maybe a minority, you are disproportionately feeling the effects. You are more likely to be out of work. You're more likely to feel insecure in your current job. You're more likely to have taken a pay cut. So we have this thing where kind of rich, educated people are doing fine. Poor, more middle class people, working class, are struggling. And that K-shaped recovery is having a huge impact on the housing market. A massive impact on the housing market, where almost all of the demand for homes that's come in 2020 and early 2021 is coming squarely from wealthy, high credit score households. Wealthy, high credit score renter households are the ones fueling the home buying spree right now. This is actually very different than what was going on in the mid-2000s. In the mid-2000s, it was actually the lower end of the market. It was people who didn't really have a job or even income who were getting loans and fueling home buying demand. Now it's actually the opposite. It's high earners, high credit scores fueling home buying demand. And for a second, you might think, oh, that's a good thing for the market, that it's reputable borrowers with high incomes and good jobs who are buying homes. Well, it's good for the market in the short term, as people with high incomes who buy homes can pay higher prices, right? But it's actually pretty bad for the market in the long run. Because basically what COVID has done is it's accelerated the home buying decision of lots of what you call renters by choice. These are the wealthy renters, high credit score renters, who would have always bought a home at some point in the future, but because of COVID, they decided to buy a home now, right? All of a sudden with COVID, space was at a premium, interest rates were low, now was the time to buy. So imagine, a couple, early 30s couple who lives in a luxury apartment building in downtown Boston or maybe in New York. All of a sudden the lifestyle in those areas became very poor, and they were like, oh, now's the time, we need to go to the suburbs and buy a home. That's essentially what's happened over the last year. Great for the market in the short run, bad in the long run, because you got to ask the question, if that couple normally was going to buy in 2022, but then accelerate the decision in 2020 because of COVID, who's going to backfill their demand in 2022? Who's going to come in and then fill their spot in terms of a renter becoming an owner in 2022? And I want to illustrate this point to you guys using like a hypothetical situation. So on this chart, we're looking at a hypothetical economy over 3 years. In 2019, this economy has 20 home buyers. So you can see 20 different X's here. This represents the amount of home buyers each year in this economy in 2019. In a normal, healthy housing market, the amount of home buyers will increase incrementally each year. 21 home buyers in 2020, 22 the next year, 23 the next year, plus one, plus one, plus one each time. And then we'll have, let's say, 66 home buyers over that full duration from 2020 to 2022. This is a healthy home market, a healthy housing market where we see gradual increases in home buying demand. However, this is not the market that exists currently. This is the market that exists currently, where we had 20 home buyers in 2019, but then all of a sudden we were plus 3 in 2020. We had a big increase in demand in 2020 from those renters by choice I described who accelerated their decision. We also had high demand in 2021 at 23. But then in 2022, we're going to see a decline in demand, because essentially we took some of these X's that would have been in 2022 and we put them in 2021 and 2020. So this is the gigantic home buying demand illusion that's going on right now in the housing market. We're thinking that long-term demand is strong because we're seeing the plus 3 in 2020, we're seeing the 23 in 2021. But what no one's paying attention to is that around the corner, we're going to have a big decrease in home buying demand. And in fact, we're actually going to have less aggregate home buying demand over the 3 years because we're in a recession, right? We're in a recession where lots of people have lost their jobs, lots of people feel financially insecure. We're actually going to have an aggregate decrease in home buying demand, but that decrease is going to squarely be felt in 2022. Now, I think you guys might be saying, all right, Nick, I understand the logic you're saying, but you just kind of made up this fake hypothetical economy. How do I know that this is actually happening right now in the US housing market, in the US economy? Well, you don't need to look far into the data to see the proof. If you look at data on the credit scores of people who are getting mortgages over the last year, it is disproportionately people in that high credit score range, 760 plus. 760 plus credit score, probably high earners. They are fundamentally driving the mortgage origination and home buying demand of the last year. And like I said before, this sounds good, but it's actually bad in the long run because there's only so many of these households that exist. There's only so many high earning renter households with good credit scores that are going to convert to buyers. Eventually, we're going to run out. Not run out completely, but we're going to see a big drop off in that segment because basically we're borrowing the demand from the future into the present for that segment. There's only so many households that meet the credit score and income criteria to get a loan right now. And you can see what I'm talking about on this graph. And this graph is taken actually from a Wall Street Journal article that was posted on April 2nd, and I'll put the link to it in the description. And what this graph is looking at is mortgage originations by credit score. And so we can see actually that in 2020, we had record amounts of mortgage origination volume for new homes, record amounts. But what's very apparent is if you look at the shading of these bars, that increase in mortgage origination demand comes squarely from high credit score households and individuals. We can see this light green bar is the 760 plus credit score. The dark green is the 720 to 759. So this is proof, this is evidence that all of the home buying demand over the last year is really just coming from high income, high credit score individuals. And as I said earlier, you can see this is in stark contrast to what occurred in the early to mid 2000s, where you could actually see big increases in these red bars in the early to mid 2000s, which are low credit score mortgages. There was a big drop off, and then never has there been a rebound really in originations to low credit score individuals. So again, this is proof that the run up in housing we're seeing over the last year is squarely coming from high earner, high income households with good credit scores. And there are only so many of these people, right? When you jam a lot of high earners into the housing market in a short span of time, that will definitely cause price appreciation. People with high incomes who can afford to overpay for real estate will do it if they want to own a home. But who will backfill that demand in the future? And who will sustain the continued increases in demand that the housing market will need? Who will get that home ownership rate from 65.8 to 66.5 or 67% into the future? That's a great question because I don't see who's backfilling the demand right now. Because again, we're in a recession. Lots of low and middle class households feel financially insecure right now. They do not feel like they are in a position to buy or own a home. And even if they felt like they were in the position to do that, they couldn't get the loan because mortgage availability and credit standards are at some of the strictest levels they have ever been right now. That's right. If you don't have a great job and a really high credit score, you are probably not going to get a loan to buy a house right now. So the Mortgage Bankers Association, which is a trade group which represents the interests of lenders and mortgage bankers, they track credit availability across the housing market each month through an index which basically measures like what are LTV constraints, what are income restraints, credit restraints, and they aggregate that into an index which shows how hard is it to get a loan right now. And the answer is, in March 2021, it is very hard to get a loan. And you can see what I'm talking about on this graph, which is basically that mortgage bankers mortgage availability index. And what you can see is it just fell off a cliff in early 2020 down to basically the same levels it was at in 2013, 2014, right after the financial crash. So banks and lenders right now have similar feelings of insecurity about lending as they did right after the financial crash. And this is going to cause problems for the housing market because once that low-hanging fruit of high earner renter households dries up, who's going to backfill it? Who's going to start buying the homes to sustain the demand? Well, I don't know. If you don't have a good job or you have financial insecurity or a poor credit score, it doesn't seem like you can get a loan right now. So now you can see the gravity of the situation. We have really three fundamental things going on that are going to suppress demand in the housing market going forward. A lot of those high earner renter households who would have bought in a year or two already bought. So their demand isn't going to be there. You have a lot of lower to middle income households who might have bought, they might have grown into home ownership over the next couple of years, but they feel financially insecure right now. They might have lost their job or they might have not gotten the raise they expected. They're not going to buy a home. And on top of that, you have mortgage lending, which is very strict right now. So even if some of those former people wanted to buy, they might not be able to get a loan. So now you see how home buying demand is set to fall off a cliff at some point over the next year. And when home buying demand falls off a cliff, you know what that means for home prices. They're going to go down. And this is something that every home buyer and real estate investor needs to understand. But wait, there's more. A lot of the demand over the last year, in addition being fueled by the high earner renters, was also fueled by investors in speculation and people buying second homes. The amount of mortgage applications, the percentage of mortgage applications for second homes and investor homes has doubled as a percentage over the last year. So that's even more, again, high earners just coming in and buying up homes. And again, while that can support short-term price appreciation, it cannot support long-term price appreciation. It's actually going to destabilize the market because when a lot of these investors and home flippers buy homes today and they realize pretty quick that the fundamental demand is drying up, they're going to flood the market with inventory at some point. So the short-term demand they created is going to turn into long-term supply for the market. Especially because, and this is really, no one's talking about this, Fannie Mae just tightened lending standards on people buying second homes and investor homes. That's right. It's now harder to do that. They did this policy change in mid-March. They basically capped and lowered the amount of mortgages that they are willing to buy from banks that are investor loans or second home loans. So those loans are going to get more expensive going forward, and it's going to lower investor and second home demand. So Fannie Mae right now is actually doing something which is going to constrain mortgage origination and home buying demand in the market. And you're going to see a lot of these investors and second home buyers have remorse in a year or two as they're paying property tax bills or paying mortgage interest. And they're going to realize that the housing market's running out of steam. They're going to put their homes on the market, right? And that's going to increase supply and the phantom demand is going to evaporate. There's one other thing I want to touch upon, and that's interest rates. I talked to a lot of you guys out there in the comments section. I talked to a lot of investors out there, and a lot of people think that just because we have low interest rates, that's going to sustain home price appreciation. And I just want to stop that right there. That is not true. So low interest rate environment, which causes low mortgage rates, that can cause a temporary increase in home prices. That cannot cause a long-term increase in home prices. Because basically, you got to think about what is the fundamental hurdle for most people to own a home. It's not actually the mortgage payment, it's the down payment. So while lower mortgage rates might have pushed some of these wealthy renters to decide to buy, in the same time, it's increasing prices and increasing down payment levels. And those down payments, that's the fundamental hurdle for most middle class or poorer households from participating in home ownership. And you're going to need those households to become home buyers if you want to keep increasing the home ownership rate and keep increasing home prices. Those poor and middle class households are going to have to become home buyers. But with home prices, in some markets doubling over 5 years, those down payments are getting the levels that poor and middle class households can't afford. So low interest rates, yeah, they can cause a short-term increase in home buying demand and prices. They cannot cause long-term increase in home buying demand and prices. At some point, the higher down payments are going to push people out of the home buying market and lower demand for homes. So I know this was a pretty technical and data-driven video. I hope you guys were able to stay with me through this, but I think if you did, you're going to see the point that I'm making here is that the home buying demand in the short run is kind of fake. It's being stimulated by short-term dislocation in the market, wealthy renters and investors flooding in to buy homes in the short run. However, there's only so many of those people available to fuel home buying demand. As they're doing that, lower and middle income households continue to get priced out. They're getting priced out at a time where there's a lot of economic insecurity and where they're not going to be able to probably get a loan. That's a recipe for home buying demand falling off a cliff over the next year, and when that happens, home prices are going to go down, and it will likely be a better environment. If you're thinking of buying a home, or if you're an investor thinking of investing in real estate, it's probably going to be a better environment in the next year, especially when you consider this in context of the first video I made, which I have a link to in the description. If home buying demand goes down as the inventory and supply of homes goes up, which is the point I made in that first video, supply will go up, well then you have a recipe for a housing crash. So I hope you guys enjoyed this video. As I said before, I spend lots of time making this content. I love sharing this data with you guys. In return, all I ask, just hit the like button and also leave a comment maybe. I want to hear what you think. What are your thoughts? What are your experiences right now going through the home buying process? Where do you think the market's going to go? So make sure to hit the like button and leave a comment. All right, guys, that's it for today. Next week, I have part 3 in this series coming out. It's about how prop tech is inflating the housing bubble and will also cause deflation and a crashing of the housing bubble, how prop tech will cause that. So make sure to hit subscribe. Make sure to turn on your notifications so you're not going to miss that video next week. And until then, this is Nick from Reventure Consulting signing off.